Now, state taxing policies may vary from state to state, so you have to look at your state entity to see if they will charge state income taxes for capital gains, as well as how aggressive they are. Now, my business partner is Ruth Benjamin. She's a capital gains tax strategist. A little bit about her. She has a little over 22 years experience as president of 2 title company owned 1031 exchange companies. She is the current general manager of National 1031 Exchange Services, and she teaches webinars every Thursday on how 1031 exchanges works. She has 5 years as a capital gains strategist working with multiple strategies. A little bit about me. My name is Scott Varney, and I've been licensed for real estate in Texas since 1996. I used to close up to 61 clients per year, so I was ranked in the top 0.2% nationally as a producer. I'm currently in the financial services industry with a life and long-term care insurance and annuities business, and again, I am a capital gains tax strategist. Disclaimer: this presentation includes financial discussions and is not to be construed as financial advice and not to be considered legal advice. Please note in this discussion we use the word save, which refers to the financial and tax implications within a given year and more accurately refers to tax deferral in perpetuity pursuant to Internal Revenue Code Section 643. For formal tax advice, we recommend you seek the services of a duly licensed professional. Now, in this presentation, we are going to go over the problems we face and the solution to the problems. And with that solution, we're going to have a technical overview. That's the stuff that you get lost in. And then we're going to break it down in simple terms. Now, we are also going to go over the process of how to get set up with the strategy. Problem number 1. So just so that you know, I am the bearer of bad news. And my partner, Ruth, she's the one that's going to be the good news girl. So I'm the bad news guy. So problem number 1, capital gains taxes. Capital gains taxes for sale of assets, most of the clients we work with, they have to pay 20% federal tax rate. Also, net investment income tax, which we know as Obamacare, is another 3.8%. Again, state taxing policies may vary from state to state. Here in California, it could be 13.3%. That is a big tax bill for those who want to have options and flexibility with their highly appreciated assets. So when you go to sell your asset, you're going to have to pay a lot of taxes to have flexibility. Practical example, let's say after closing costs are paid, you have an asset sale of $1 million. Your cost basis is $250,000. Your improvements, let's say you put $100,000 into improvements. Your capital gains is $650,000. So the 23.8%, the federal tax and net investment income tax is $154,700, plus potential state tax, plus depreciation recapture, plus debt over basis if you have that. So how much will it cost you to have flexibility with your assets? How much will it cost you to retire and not deal with tenants and toilets? As a heads up, even if you're not depreciating your property, the IRS will require you to pay 25% of the depreciation you should have taken during the time of ownership of your investment property. Problem number 2, 1031 exchanges. Now, many people love 1031 exchanges. They do provide great value to investors. However, there are problems that do arise. 1, the time restrictions, the 45-day and 180-day requirements that come with 1031 exchanges. You have to identify properties in 45 days and purchase them within 180 days. There's a lot of stress that comes with that. Some of the big stress is because 40 to 60%, depending on the market, of the 1031 exchanges fail. People identify properties, but they compete against other offers and lose. Or they put a property under contract, and during the inspections, they find out it is a major, there are major problems with the property. Well, they're outside of the 45 days. They cannot identify another property. and that could be a major problem. Most 1031 exchange accommodators will not allow you to rescue a failing, not failed. Failed is outside the 180 days, but a failing exchange is within the 180 days with some form of structured installment sale according to IRC 453. So that's another problem that comes up. If your exchange is going to fail, then you're going to be paying the tax bill the next year. As I like to say, the tax bill cometh due if your exchange fails. That's a lot of stress. Problem number 3, income taxes. Now, many of the investors that we talk to, they make a good income with their full-time jobs. That's how they can afford to buy investment properties. Well, therefore, their rental income is often taxed at a higher tax bracket, which significantly impacts the return on investment. However, investors counter much of the tax bill with the depreciation, which is a great strategy, but many do not realize that depreciation is a tax deferral strategy and not a tax elimination strategy. The IRS will require that 25% of the depreciation taken is to be paid upon the sale of the property if that sale is not done in a tax-advantaged way. Problem number 4, the future laws. 1031 exchanges, well, it's continually proposed to be eliminated as a tax strategy. As the U.S. debt grows, this becomes a stronger consideration. You know what? You can search the Tax Foundation website for updates on proposed tax laws, and that is one that is on the table currently. Another one that's on the table, step up in basis. Now let's go back to that one example. If you bought the property for $250,000, let's say you pass away and it's worth $1 million. Your children inherit the property. What will happen is you paid $250,000 for it, but they get a step up to the current value of $1 million. So if they sell immediately, their tax basis is $1 million. So they will have little to no taxes to pay if they sell immediately. That's a step up in basis. However, that is continually proposed to be eliminated as a tax strategy. And according to the Tax Foundation's report back in March or April when I was reading it, it said that they are addressing that and looking to get rid of that as well. Too many investors are relying on these tax benefits for the transferring of their assets, basically transferring of their wealth, and minimizing the capital gains tax bills. While those laws stay in force, it's a great strategy. We always go based on what we have now. So we can't foresee exactly what's going to happen in the future. However, if those strategies are eliminated, which they're always on the table, that could provide trouble. There is still a death tax to address. Right now, it's $11.58 million per spouse exemption that applies to the estate. In 2025, we have the sunset clause. It's going to go back to $5 million per spouse and will be adjusted for inflation. Problem number 5, personal and business liabilities. Lawsuits abound. Our home, if we can get sued if someone trips over something in our yard, even if they were trespassing. For example, I used to have a dog door. I used to think, okay, if criminals jump my fence and go through the dog door, they're going to meet 2 German Shepherds. Not a problem for us, except that I learned that if my dogs attacked them, I would get sued. I would lose because they got bit by my dogs on my property, even though they were committing a criminal act. If we drive, we are always at risk if we are at fault in an accident. If you have a business, there is great exposure and liability. Property owners are liable for all injuries incurred due to hazards associated with their property, whether a home or a business. Slip and falls annually are the #1 most common personal injury lawsuit. Since 1980, personal injury lawsuits have increased by 30%. About 25,000 people a day are, quote, victims to slip and falls. So don't become a statistic. According to IFG Services, Americans have a 33% chance of getting sued, and according to the American Medical Association, 63% of all surgeons get sued. That's almost 2/3 of the surgeons. There are almost 110,000 lawsuits filed every day in the U.S. The average lawsuit for business costs $72,500. Currently, the U.S. has over 91,000 personal injury lawyers. We like to call them ambulance chasers. Well, most of them work on a contingency, and their fees range from 30 to 40% of the award. Now, problem number 6, Corporations and LLCs don't protect you as well as you think. This was a shocker to me. I have an S corp, and this is pretty interesting information. It's easy to pierce the corporate veil in a lawsuit because they are tightly held entities. You are operating under your alter ego. The courts claim that you are the controlling owner of the entity, which is a very winnable argument with the judge. Piercing the corporate veil. Roughly 50% of entities can be pierced because they are not operating with their business properly when it comes to the records, the meetings, and the minutes. If those records were pulled into court, that is an easy way to pierce the corporate veil. Once you have your trust set up, which is what we're going to talk about, it is done. No more meetings and no more corporate minutes. All right, the state courts on average pierce 39% of cases. The federal courts pierce 41% of the cases. So generally about 4 times out of 10, the corporations are pierced and the assets are accessed in the lawsuit. That's not a preferable way to hold properties. Now, a trust is not a person, whereas in all states, entities like C Corps, S Corps, LLCs are recognized as the equivalent of a person. In all courts, lawsuits can be filed against people or the legal equivalent of a person. Our trust is a contract and is not recognized as a person. Therefore, our specialized trust cannot be sued. Problem number 7, insurance is only a partial solution, not the solution. Umbrella insurance policies do not cover punitive damages in many cases. And what is that? That is if you are sued for gross negligence. So the punitive part is the gross negligence part. And if you have umbrella policies and you lose and have punitive damages, the insurance will not cover that part of the damages or the award. However, you still may want to have an umbrella policy depending on your circumstances. Problem number 8, filial responsibility statutes. So 30 states have what's called filial responsibility statutes, which allows long-term care facilities to seize the assets of adult children to cover unpaid bills of their parents. So if you have a parent who is in a care facility and they are not paying the bills, the state can have the facility go after the adult children's assets to pay those bills. So take a look here. Are you in one of those states? Ruth and I are in California, which is one of those states. Problem number 9. All of the other problems that we did not mention. And I'm sure you might have thought of others. So now, Ruth, who is our good news girl, is going to go over the solution to all of these problems. Go ahead, Ruth.
All right, now I get to talk about the solution. So let's break it down a little bit and talk about the trust that Scott alluded to. This trust is a non-grantor, irrevocable, complex, discretionary spendthrift trust. This trust has 58 copyrights. It is a contract between the grantor, the trustee, and the beneficiaries. It was designed by a collaboration of tax attorneys, CPAs, trust attorneys, contract attorneys, and it took over 12 years to perfect this document. It's your rule book on how to handle your assets. It's been around since 1996, and it's been copyrighted since 1999. It's all based on IRS codes 643A3 and 643B. The primary purpose of this trust is both tax reduction and asset protection. So the irrevocable portion of the trust, that's what provides the Iron-Clad Asset Protection. The discretionary portion, this is what eliminates capital gains taxes, and provisions address income tax issues. It helps to mitigate income taxes paid by the self-employed. Now the complex trust does exactly the same thing. Eliminates capital gains taxes and helps mitigate income taxes paid by the self-employed. The non-grantor portion of the trust provides the asset protection, and the spendthrift provision also adds the protection for your assets and provides tax benefits. As these definitions suggest, this unique type of trust is designed to protect assets and to defer, reduce, or lessen taxes. It also eliminates liability and provides for beneficiaries without legally affecting the corpus of the trust. The corpus of the Spendthrift Trust is not subject to turnover orders by any court or judge, whether federal, state, or local. Now, the corpus of the trust is simply the trust's checking account. We have a couple case rulings that support this trust. Edison versus McLaughlin ruled that persons may adopt any lawful means for lessening of the burden of income taxes. In Weeks versus Sibley, the courts ruled that a spendthrift trust organization is not illegal, even if formed for the express purpose of reducing or deferring taxes. We also have a private letter ruling that supports this type of trust, and it was issued back in May of 2015. So let's break this down in simple terms. This trust defers capital gains taxes for generations, and the state taxing policy may vary from state to state. So how exactly does that work? When you buy and sell properties from your trust, federal capital gains taxes are eliminated as they convert to extraordinary dividends, and the taxes in extraordinary dividends that are passive are then deferred in perpetuity. So a trust has to have an ending date to be valid. This trust will end 21 years after the death of the last heir from when the trust was created, with an option to renew the trust every 21 years. So this trust can last 10, 20, 30 generations, hundreds of years. This trust will be taxed either when the trustee decides not to renew or 21 years after the last heir to the last beneficiary has passed away. The roots of our trust come from the Dynasty Trust, so the Rockefellers and the Kennedys have this type of protection. It is an ultimate tax deferral vehicle, so it uses IRS Rule 643, which states that the trustee has sole and absolute authority to designate income as extraordinary dividends or taxable stock dividends, and that it is paid to the corpus of the trust and not subject to distribution. It is not income to the trust according to Rule IRS 643. So the assets in the trust, you would buy and sell your real estate, your businesses, your stock and bond market trading, your Bitcoin, cryptocurrency. You can sell assets to another trust. There is no federal or state probate and no gift tax. So zero federal capital gains on the growth or sale of trust-owned assets. The sale of the assets to the trust are non-taxable events because you're selling at basis. You are not gifting your properties to the trust. You are selling them at basis. So unlimited amounts of assets can be sold. So there is no need necessarily to have an LLC for each property that is sold. So the trust eliminates the need for 1031 exchanges. So the trust now sells the asset and the sales proceeds go to the trust. There are no restrictions as to how and when those funds are used. You can choose to invest outside of real estate if you choose, but if you do decide to buy real estate, when you find the right fit while not dealing with the stresses of the very limiting 45-day, 180-day requirements that come with 1031 exchanges. So passive income. Passive income is like your rental and lease income from your property or business. Stocks, future sales of your properties now are paid to your trust. So zero capital gains taxes are due when the property or the business is sold. Now this can also lower your income tax, your annual income tax by 78 to 97%, which is then deferred in perpetuity. Now the trust can mitigate active income taxes paid by those who are self-employed. This does not work for W-2 employees unless you have a side business. So you would create a business trust which would go along with your beneficial trust, and that business trust, if you're actively working the business, you're putting in the hours, it can reduce your annual tax liability 78 to 85%. So what does that mean? If you normally have a tax bill that you're paying of $50,000, it can potentially be reduced to between $7,500 to $11,000. So the beneficial spendthrift trust expenses, these are a few examples of what now you can pay out of your trust checking account. Your home expenses, your mortgage, your pool guy, your cleaning lady, your car payment, your gas and your maintenance for your car, your medical, your contributions, your tuition, room and board at college, wellness, interest on credit cards, telephone bill, life insurance premiums, bank and credit card charges, and postage. So all of these expenses become trust expenses and are no longer after-taxed income expenses. The only thing that you cannot pay for is your personal food, personal fashion, or personal fun. So initially you sell all of your assets to the trust, or just some of the ones that you want to sell to the trust. It's not required that all of your assets are put into the trust. But in doing so, you create a demand note. The trust now owes you. Each year, you can have the trust pay you a portion of the funds owed to you by the trust, if you need it. There will be a small interest rate that the trust owes you, so a very small portion of those funds will be taxable. So right now, the first $12,400 per spouse is exempted on your income taxes. That means for a couple, the first $24,800 pulled from the trust for your food, fashion, and fun are not taxable. Then, if you need some more funds, you can pull $30,000 in the same year against that demand note. Now you have $54,800 to be used for food, fashion, and fun, with a very tiny tax consequence. Then, let's say you need another $19,750 pulled out in the same year, you would be in the lowest tax bracket, which would be about 10%. Now, Nelson Rockefeller says it the best. The secret to success is to own nothing, but control everything. So the trust timing and process is contact Ruth or Scott for a consultation. In some cases, we may include the attorney to answer any legal questions that you may have. If you are ready to move forward, the docs will be drawn by the legal team and the EIN number will be established for the trust. If possible, set up the trust before listing your property for sale. If your property is already under contract, the name of the seller will have to be changed to the trust, with all parties to the transaction agreeing to sign the changes. Now, you don't have to be selling a property to set up your trust. You can do this now. So you would have the asset protection and you can lower your income tax bill when it comes to your rents. All right, the pricing for these trusts typically range from the beneficial trust, which helps on the passive income, and the asset protection, that's $49,000, and the beneficial trust, which helps on the passive and the active income, that's $89,000. And then the business trust, if you have two partners in a business, you want to have one business trust and two beneficial trusts for a partnership. That's $120,000. For each one of these pricing programs, it includes the first year's prepared tax return and 1 year consultation for any questions that you may have. Now, there could be additional charges apply if you have multiple conveyance documents that need to be prepared. So the benefits of this trust, does it eliminate federal capital gains taxes? Yes. Now remember, in some state taxes, it's going to eliminate state taxes also. Does it defer income tax on passive income in perpetuity? Yes. Does it avoid lawsuits? Yes. Does it avoid judgments and liens that can reach your business assets? Yes. Does it avoid judgments and liens that can reach your personal assets? Yes. Does it avoid probate upon death? Yes. Does it avoid gift tax and estate tax? Yes. It ensures the transfer of your assets go to your beneficiaries. Yes. Multi-generational wealth accumulation. Yes. Does it avoid annual fees? Yes. So this trust eliminates federal capital gains taxes without doing a 1031 exchange. Now, in some sophisticated living trusts, there can be some limited asset protection that you have. Even if estates are worth over $11.58 million, no gift tax or estate taxes will be owed by your heirs. So please reach out to us. We would love to have a conversation with you. Scott's information is here. My information is here. You can go to go.oneshub.com/defer tax to reach Scott, and to reach Ruth, go.oneshub.com/no gains tax. We do webinars every Tuesday and Thursday. Tuesday is regarding the trust, and Thursday is 1031, and both of them will touch on monetized. But go to our website, deferthegainstax.com, and sign up for our weekly scheduled webinars. Please reach out to us. We would love to talk to you. So we look forward to speaking with you. Thank you.
All right, I want to thank everybody for being here today. Oh, I don't know why it's doing that, so I'm going to go ahead and disconnect. If you have any, or you need any tax deferral information, please reach out to us. I don't know why it's doing that. So, all right. You want to do a 1031 exchange? You want to defer? Call us. I'm going to end it.